Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Welcome to the debate. Today we're looking at Oriental Rise Holdings Limited, or ORIS. It's just a fascinating case study, a real flashpoint for that classic tension between technical trading and, well, deep operational distress. We've seen a violent decline, some very aggressive financial maneuvering, and now this sudden speculative surge.
It's a critical one to unpack. ORIS really puts a spotlight on how corporate restructuring and, pure speculative mechanics can sometimes defy, or at least appear to defy, some truly catastrophic fundamentals.
Exactly. So the central question we have to tackle, coming right out of the recent market action, is this. Is what we're seeing in ORIS a legitimate, sustainable technical reversal that's being driven by smart restructuring and a supply shock? Or is it just an unsustainable blip, a fluctuation built on fundamental decay and the constant threat of toxic financing?
And I'll be arguing the skeptical case here. While this tactical rally has grabbed headlines, the deep, documented operational distress and the frankly structural overhang of that July 2025 death spiral financing, it just means this price surge is inherently fragile and ultimately capped by guaranteed dilution.
And I'm going to take the opposing view. I maintain that the 1-for-20 reverse stock split, combined with the Hubei Dagwon acquisition announcement, is a powerful wombo combo of catalysts. What we have here is a classic volatility arbitrage opportunity driven by a manufactured supply squeeze that I think isolates the current trading from past failures. My core thesis is that the market is now reacting to what is effectively a special situation. It's firewalled the current trading environment from all the historical baggage. The revenue contraction, the margin collapse, that's history. The focus now is on the future capital structure, and the first key piece of that is the structural change from the 1-for-20 reverse split, effective December 30th. Yes, it was to regain NASDAQ compliance, to get over that $1 threshold, but its real power is in what it did to the float.
A forced compliance move, though.
Just drastically shrank the tradable float. And this low float structure is the necessary tinderbox that allows even small retail buying to generate these huge price jumps. It's pure supply shock mechanics.
Okay, that reduction in float is an undeniable technical factor. I'll grant you that. But the structure you're describing was built on the complete collapse of trust and a 98% loss of shareholder value. So the technical environment might favor a squeeze, but only because the company's underlying business is, frankly, defunct.
I understand the skepticism, but the technical indicators were already confirming this reversal potential. The 14-day RSI was deep in oversold territory at 32.86, a classic bottoming signal. And more telling, the MACD generated a clear, unambiguous buy signal on December 26th, anticipating the explosive move we saw just a few days later. You combine that technical pressure with the fundamental catalyst, the letter of intent for Hubei Dagwon T, and you get the narrative shift you need for momentum.
I see that management is attempting to create a new narrative, but we can't just ignore the depth of the operational decay they're trying to paper over. The stock's massive collapse wasn't random. It was a direct result of financial flaws that are still in existential threat. This company is in severe contraction. Revenue plummeted 35% in the first half of 2025. Gross margins collapsed from, a somewhat healthy 35% down to a disastrous 18%.
But the acquisition is meant to address that margin collapse. It's a forward-looking fix.
Perhaps, but you have to look at the present reality. Net income for the first half of 2025 was a negligible $108,000. And most critically, ORIS has negative operational cash flow to the tune of negative $1.5 million for that half year. This is the crucial point. They cannot sustain themselves. Liquidity is only maintained through continuous aggressive dilution.
That's historical performance.
And the mechanism for future failure is still structurally embedded, the toxic overhang. That July 2025 financing introduced 14.8 million common warrants with what we call toxic reset provisions. And let's be specific about how insidious this is. These warrants had a zero exercise price option, meaning holders could essentially double their share count without spending a dime. And on top of that, the contract had automatic downward price adjustments to 70%, then 50% if the stock price dropped. Right, that's classic death spiral financing.
Precisely. And this structure does more than just guarantee future dilution. It actively incentivizes the warrant holders, these are sophisticated pipe specialists, to short the stock, drive the price down, trigger the resets, and maximize their own payout while just decimating any retail buyer. That financial engineering is a permanent structural ceiling on any rally you're hoping for.
And that brings us to our first real point of contention, the true nature of ORIS's liquidity and this so-called net-net argument. I acknowledge the cost of that financing, but let's talk about the result.
The result was this anomalous cash position. At its absolute lows, ORIS was trading at a valuation between, $5 and $10 million? Yet it was reporting $42.1 million in cash as of June 30th. That massive disconnect, the stock trading below liquidation value, is what created that net-net floor that fueled the retail speculation.
And that rational floor is critical. The presence of that cash, regardless of its painful origin, gave management the buffer they needed to even attempt a strategic pivot. Without that $42 million, the company was facing insolvency. It bought them optionality, and that optionality is now being leveraged with this acquisition news. The cash gives them the ability to look forward.
But this is where context is everything. That cash wasn't generated by selling tea. It was generated by selling shares at fire sale prices. The IPO in October 2024 was for, 1.75 million shares. Then comes the July 2025 offering, which injected nearly 30 million potential new shares, the shares plus the warrants. This is hyperinflationary supply. To call that 42 million a buffer is misleading. It's just future dilution that hasn't been monetized yet.
It may be dilution, but it's targeted dilution toward a strategic goal. That's why the acquisition is so important.
But we also have to talk about the elephant in the room that even 42 million can't fix. The geopolitical risk of the variable interest entity, or VIE structure. ORIS operates through a VIE, which is common for many Chinese companies on U.S. exchanges. But this legal setup is under constant scrutiny, especially with regulations like the Holding Foreign Companies Accountable Act. So even if the balance sheet looks solid for a moment, the legal foundation is shaky.
That's a valid structural risk, but the current price action is all about the microstructure, which leads to our second point. Squeeze mechanics versus institutional distribution. I maintain the short squeeze narrative is the primary force here.
You're focused on the surface.
Look, we have about 1.58 million shares reported as short interest. Compared to the now drastically reduced post-split float, that is a massive amount of short volume. On top of that, the cost to borrow fees are high, which confirms short sellers are under pressure. The reverse split didn't just shrink the float, it intentionally cranked up the financial pressure on anyone holding a short position.
I'm just not convinced the short interest guarantees a squeeze, because the real trading is being obscured by institutional activity in dark pools. We have to look at the FINRA data. It shows the off-exchange short volume ratio recently hit an astounding 57.53%. In a normal stock, that ratio is usually around 30, maybe 40%.
Okay, but why does that anomaly matter so much?
It matters because more than half the trading volume is happening off the public exchanges, away from the visibility of the average investor. This high dark pool volume is entirely consistent with those institutional warrant holders, the pipe specialists, methodically executing their sales off exchange.
So they're just selling into the strength?
They are using this retail buying interest as exit liquidity. They're slowly, surgically liquidating the position created by those toxic warrants without causing a panic on the Nasdaq. If it were a genuine short squeeze, we'd see volume spiking on the exchange. Instead, the institutions are managing the flow for a profitable exit. It's distribution, plain and simple, just dressed up as a volatility rally.
That's a very pessimistic read. I'd argue the high short interest, combined with high fail-to-deliver shares, FTDs, suggests that institutional maneuvering might be hitting a wall. High FTDs are a primary indicator that real shares are hard to find. It's the very definition of a constrained float and the precursor to a forced buy-in. If retail investors lock up the float post-split,
and hold the price above, say, that critical $1.30 pivot point, clearinghouses will eventually force those buy-ins, overriding any dark bull strategy. Forced buy-ins might trigger a temporary spike, sure, but that spike runs headfirst into a structural ceiling. Which brings us to our third point, strategic value versus the structural ceiling.
All right, let's talk about the potential value first. The Hubei-Dagon-Lowy is a necessary vertical integration play. Management is trying to fix the margin collapse at its source. An 18% gross margin tells you they're just a reseller. This move to acquire plantations and modern processing facilities is an attempt to shift their whole model toward premium branded products and actually capture the margins they're currently paying out to suppliers.
The fundamental improvement is aspirational. The structural ceiling is contractual. Even if the acquisition closes, that death spiral warrant overhang remains an absolute cap on the stock price. Let's just play out your scenario. ORIS rallies toward, 175, 285. The warrant holders look at their contracts, which let them exercise at a deep discount, sometimes zero cost. They immediately flood the market with newly minted shares, selling right into that retail liquidity.
They're monetizing their position.
They're monetizing it at the direct expense of anyone buying in. Their guaranteed supply of new shares immediately caps the upside, dilutes the share base, and restarts the whole cycle of price depression. They have a financial product that is designed to profit from a retail rally, ensuring that rally is perpetually restrained.
But management is taking a calculated risk that the value from vertical integration outweighs that short-term dilution. By shifting their product mix, they might get to a gross margin closer to 40%, making them a fundamentally healthier business. That stability is the only way they can eventually renegotiate or get out from under that toxic financing.
So what you're suggesting is that the path to eliminating dilution is paved with more dilution. That acquisition isn't free. ORIS, with its limited cash, will almost certainly have to issue millions of new shares to the sellers of Hubei Daguan or raise more dilutive capital to fund it. The proposed solution to the dilution problem involves more dilution, just under a different name. It's a bet on an uncertain future against guaranteed present dilution.
Well, that's the nature of this volatility arbitrage. It's a high-stakes gamble on management's ability to execute a transition, all leveraged by a highly constrained market structure. And the price action suggests some buyers think they can pull it off.
And the off-exchange data suggests the smart money sellers think this rally is just their exit ramp.
To summarize my position, ORIS is without a doubt a high-volatility, high-risk opportunity. But it's driven by a confluence of powerful factors right now. A supply shock from the reverse split, a demand shock from the acquisition news, and forced tactical short covering from the low float. The key measure for the bullish case is simple. Can support at the split floor of $1.22 hold? And can the stock break through that institutional resistance at 175?
And I'll conclude by saying that while the tactical rally is a technical fact, long-term investors need to exercise profound caution here. The foundation is just fundamentally unstable because of the operational collapse and the structure of those toxic warrants. These instruments are designed to benefit arbitrageurs by guaranteeing future supply and capping the upside of any retail-driven rally. That capital structure remains compromised until that toxic overhang is gone, and that is a highly improbable event in the short term.
This case really is a perfect example of how radically market microstructure can diverge from underlying business performance.
It is. The ultimate fate of ORIS hinges entirely on the successful and accretive closing of that Hubei Daguan deal and the incredibly difficult task of unwinding that dilutive financing. The listener really has to weigh the high-risk volatility arbitrage opportunity against the enduring structural nature of the financial risk.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.